It's worse than we thought as rising inventories will send stocks and consumer prices crashing. I'm your host, Steven Van Metre, and thanks for joining me today. And despite stock prices continue to fall, investors eagerly buy every dip, hoping for a big bear market rally. But with second quarter earnings looming, well, investors are about to find out that the big rise in inventories and an unexpectedly large rise in inventories is actually going to be bad news for stocks and send them lower, as retailers and wholesalers will be forced to discount, driving consumer prices back down. Let's head over where we picked today's story up as Walmart, Gap, and others amassed $45 billion in extra stuff to sell, according to Bloomberg, as companies bolt up amid pandemic's lengthy shipping delays, as shifts in customer preferences, no shock, may forced a round of discounts. Inventories rose almost $45 billion for companies on the S&P consumer indices with a market value of at least $1 billion that reported earnings over the last 2 weeks, according to data compiled by Bloomberg. That's up 26% from this time last year. The glut dented profits at some retailers, with Walmart paying more for storage and Target and Gap cutting prices on key goods. And this is something we talked about that would happen, that due to all this flood of goods coming into the country, and that happens when consumer prices rise in the U.S., well, foreign producers who do not have as high cost to produce as, say, U.S. manufacturers see this as a huge advantage and literally will just stuff inventory and goods into the U.S. to take advantage of that. Well, no surprise, without fiscal and monetary stimulus, inventories are rising. But I want you to see now how all these wholesalers and retailers are making this sound like it's not a big deal. Well, it will be. Of course, wait till later this year. It's far from clear what comes next. Well, not really. We'll make that case here shortly. In the past, ballooning retail inventories have signaled economic slowdowns or recessions as shoppers bought less. But consumer spending in April climbed at the quickest pace in 3 months after adjusting for inflation. And why did that happen? We talked about that. What had happened is higher energy and food prices. So yes, consumers are still spending, the same amount of money they spent before. They're just spending it in different areas. And all of a sudden, you start to see why, inventories on discretionary goods start to go up. So they're trying to compare two things that they really can't. Yes, consumers still spending. Look, it's great. But for some reason, they're not buying all of this stuff. Doesn't make sense until you understand where money's going. As long as Americans keep shopping, well-stocked warehouses could buoy retailers if port congestion worsens this summer. The just-in-time mentality is broken now, so you're seeing retailers carry more inventory than they traditionally carried. But is that really the truth? Is this just a case where, well, due to the pandemic, we wanted to stock up? Not so much. Again, this was the belief that monetary stimulus wasn't going to go away, fiscal stimulus wasn't going to go away, and all this demand. I mean, remember, it wasn't even a year ago. There was just demand, and all this urge to spend was just the beginning. It was just pent up, and the consumers were going to head to the stores. Well, what's the problem now? Is they don't have the money. And it's very clear as averagely hourly earnings, when adjusted for inflation, are negative and had been negative for broadly since early 2020. And so, yes, the issue here isn't that consumers don't want to spend. Everybody knows Americans love spending money. That's not what it is. They just can't afford higher prices. And so all of this inventory that all these wholesalers and retailers bought is now getting stacked up in warehouses because nobody can afford it. Well, that leaves us plenty of demand for retailers. Consumer tastes are changing. Well, if it isn't one thing, it must be another. It's a shift in spending habits, as Macy's says shoppers spent more in back-to-work apparel and clothing for special occasions instead of leisure wear and home goods that were popular during the pandemic when, of course, people were stuck at home. The sharper-than-expected shift left the company with a glut of merchandise that consumers don't want. That means Macy's will have to cut prices, and when you hear cut, think disinflation, think lower consumer prices, CPI headed lower. Of course, that's not what, everyone thinks is going to happen, but you can see it is happening, and it's going to happen right before your eyes. And Target, which recorded a 43% jump in inventories, was in the same boat as Gap and Abercrombie & Fitch. Walmart told analysts that it was glad inventory was higher, while acknowledging that the 32% increase in the first quarter was higher than they really want. And Macy's saw a 17% jump in inventory and said having merchandise on hand early will ensure key shopping season goes smoothly. as storm clouds looming in the supply chain once again delay cargoes leaving China and make their way to busy ports on the U.S. West Coast. As a result, the department store operator is pushing up some of his ship dates on important goods ahead of back to school and the holidays. So here now what you're seeing is, look, we have a lot of inventory, we just don't have the right inventory. But if we had the right inventory, well, it's going to go flying off the shelves. Don't you worry. Well, as of course, when people have less money to spend due to things like higher food and energy costs, which they have no choice about, well, we'll see some of this inventory. It'll get stuck on shelves. You wait and see. And similarly, Costco said the 26% jump in inventory was fueled in part by a decision to replenish its stockpile after high demand last year and as insurance in case supply chain disruptions get worse. The company expects to sell through it without really a lot of heartburn, which wouldn't be no surprise for companies like Costco, although some of the extra inventory consists of holiday goods that will still be good this year. And of course, these companies are having to pay to store this inventory, and that will eat into their profits. And ultimately, in this quarter's earnings and coming quarters, we'll find this out. And that's why it's really bearish for stocks. And of course, we see where this trend is going. And we're going to take a little bit of a detour. I want to take a quick look at the Philadelphia Fed Manufacturing Index because it really tells us something interesting here. Because as inventories rise, well, what would be the next thing? What would be the leading indicator we would expect to come out of this? Well, the cancellation or reduction of new orders. So let's head over to Philly Fed, the Manufacturing Business Outlook Survey for June. And what we see here is the diffusion index, and just keep in mind, represents the percentage indicating an increase minus the percentage indicating a decrease. And notice here, new orders, 12.4% net firms, a decrease in new orders. And why, again, why is that happening? Because inventories are too high, and if companies can't move these inventories, they're going to cut back their ordering, and that will have a major effect on the economy, as I'll show you here in some charts in a moment. A couple other important things to notice here, unfilled orders. This is really where you see inflation as a backlog of orders. Well, now 7% of firms are seeing a contraction there. How about prices paid continue to rise? Most firms reporting 2/3 of prices paid rising, but only half the firms are getting higher prices out of their goods. And that is not good when you think about margin squeeze that will come of this. So now let's take a quick look at what all of these charts mean and why stock prices are going to head lower. Now here you can see from the Fed database, the current new orders. This is the diffusion index from the Philly Fed. Now let's overlay some things so you can see here. I'll keep that in blue. Let's look at the stock market. Now we have the Wilshire 5000 in red on a year-over-year rate change, the total U.S. stock market. And notice that as equity prices go down, it leaves new orders lower. You know, we talked about this the other day, that the U.S. economy is the stock market. When people feel wealthy, they spend. And so you can see the stock market is leading new orders lower. How about the consumer price index? Well, here is on, I know this is noisy, on a monthly change, but notice that we see consumer prices can rise as new orders fall because consumer prices lag. And you'll notice that new orders fall, consumer prices are still rising, then they fall. And we see that trend here, rising as new orders fall, and now we see new orders are falling and consumer prices are still rising. And of course, that with a lag will hit at some point. And how about Treasury securities? You know, everybody believes that interest rates can only go up, but notice when demand for goods and services go down, new orders go down, yields on a year-over-year rate change, they fall too. And so it makes sense. You know, there has to be a supply and demand for credit. A lot of people don't get that. You know, if there's somehow they believe that, yes, people can spend less and consume less, but that drives interest rates up. It doesn't work that way. You know, it's consumption and the demand for buying goods and services, particularly on credit, that drives interest rates higher. So when people want to go out and borrow money, it drives rates up. If people aren't borrowing because they're not spending, rates have to come down. And that's something that my portfolio show strategy knows about. Perhaps your strategy may not. I'll put a link up here in the corner and description below, and you can see why it performs so well during recessions. Of course, as you can see, one is coming. In fact, the Fed doesn't realize it, but it's coming soon because there's more bad news in terms of what's coming for U.S. wholesalers and retailers, as we can see from this latest headline from Bloomberg, as LA port braces for peak cargo season to arrive early. So we don't, as if we don't have an inventory problem, well, we're going to get more as consumers keep buying, but they're not buying these goods. They're buying gasoline and energy and, of course, food. Port of Los Angeles, U.S. busiest port, is preparing for the early arrival of 2022 peak season for cargo as retailers stock up on back-to-school and fast fashion products despite high inventory levels. The upstream orders coming from Asia getting ready for an early arrival of peak season goods look strong. The June numbers will be very healthy. He added that the port handled just under 970,000 units of cargo in May, making it the operation's third busiest month on record. And the cargoes keep going because consumers keep buying, but they're not. That's what's notable here is consumers are going to throttle back their spending more and more and more. But I want you to understand, the broad belief is that consumers, because people are interpreting the government data as they're out spending on broad goods, when in fact, of course, gasoline, energy, food, that doesn't mean people are going to the store and spending money, but that's what people think, as those inventory levels have to be built up across a wide spectrum of retailers and porters. The shipments due to arrive are not necessarily the product that is going to be looked at for discounting and pushing out. They're going to be sold at full price, but instead seasonal goods specific to the second half of the year, such as back-to-school items. And if you think consumers are going to be able to afford them then, well, if they can't afford them now, it's not going to get any better. And Los Angeles did not see the precipitous drop in cargo that some observers had called for, as the ports and central government had prioritized as long-haul cargo coming to LA. And now we're starting to see just a little bit of an uptick, which are the peak season goods. And here you can see what that means for corporate profits as new orders head lower. And now we've got corporate profits after tax, not on a year-over-year rate of change, but notice as new orders go down, well, corporate profits go down. New orders start to slow and go down, profits go down, new orders go down, profits go down, and it starts to make sense. And you've got all this big mismatch in inventory, and what the belief is, it's okay, we're out of sync now, we're going to move all this current goods at higher prices, it'll be great, and then as the holidays hit, we've got a little deferred inventory, we'll move through it. Don't worry, the consumer spending is strong, but it's not what people think. In fact, if we know, it's just the opposite because we look at the data. Now let's take a look at today's data. We've got U.S. industrial production increased in May, but will it last as manufacturing output started to fall? As U.S. industrial production posted another gain in May, the fifth increase in as many months, but factory output weakened as firms struggled with supply chain bottlenecks and high costs. Industrial production, which includes factory, mining, and utility output, rose 0.2% in May. Key energy there with utility output compared with the previous month, losing pace compared with the revised 1.4% increase registered in April, quite a substantial drop. The U.S. manufacturing sector, the biggest component of industrial production, decreased by a marginal 0.1% in May compared with the previous month. Production of motor vehicles and parts rose 0.7%, while the largest drops were in wood products and machinery, with declines of a whopping 2.6% and 2.1%, respectively. And what does all this mean for industrial production? Well, once again, we'll head back to the Philadelphia Fed New Order Diffusion Index, and what you can see is as new orders fall, well, lo and behold, in red, industrial production on a year-over-year rate of change is set to fall. So all these wholesalers and retailers are adding up inventory and bringing it in under the belief if they stock it, you'll buy it. Well, what's going to happen in the third quarter, fourth quarter? Where do you think we're going to hear in their earnings? We have too much inventory. We're going to cut our orders, and our profits are taking a big hit, and that is bad news for stock prices. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.